Hey everyone, and welcome back to another video. Today's going to be a little bit different. We're going to be just in my computer and I'm going to be taking you through and showing you how to use my free stock analysis spreadsheet that I put together for you guys to make your stock analysis a lot easier and make your research a lot more interesting. Essentially, I've just recently updated this spreadsheet. I added a new sheet, so I'll be showing you what that is. But before we get into that, if you want to go ahead and get access to this spreadsheet, it's completely free. You just go and click the link below and it'll take you to this page, and you just enter in your name and your email, and then it will take you over to the thank you page, and you can see here that there are 3 different spreadsheets that you can get access to. So there's 3 different spreadsheets here. The first one is a 5-year spreadsheet, and this is going to be looking at 5 years of data. So if you're looking at companies that don't have 10 years of data, or you just want to look at their most recent data, then you can use this spreadsheet. Personally, I always look for companies that have 10 or more years of data, but I know that some of you out there like to look at companies that are newer, so that's why I've provided this. And then we have the 10-year version of that, which is the exact same, except it has 10 years of data. So here we go, exact same, just has 10 years from 2009 up until 2018. And then the third one is an old version of the spreadsheet. So it's got all of the exact same features, but as you can see on the latest version, the latest year is 2018. Whereas on the previous version, it's going to be 2017. So if there is any companies, I don't know if there is at this point anymore, but if there are any companies that haven't yet released their 2018 annual report, then you can use this spreadsheet to go from 2008 to 2017 instead of from 2009 to 2018. So go ahead and download the spreadsheet for free, and you can follow along if you like, but I'm essentially just going to go through each of the sheets, explain what they are again, and I'll go through the new sheet, of course, and I'll use an example. I'm just going to go through the Cheesecake Factory, which I've already entered all the data for, and I'm going to copy it over into the new spreadsheet and show you how to use it. But essentially, once you've opened the spreadsheet, this blank spreadsheet, you won't be able to edit it because it's a public document. It's one that everyone can come to and use as a template. So what you're going to need to do is you're going to need to click that link on the thank you page, and then you're going to open up the spreadsheet, and you're going to want to go File and then Make a Copy. And here you will be able to save a copy on your Google Drive, and then you will be able to edit the copy. And if you ever need a fresh sheet, then you can come back here and go to the link, and then you can just make another copy. So what we're going to do is we'll call this Cheesecake Factory because that's the example that I'm going to be using. And basically I'm just going to save it on my drive, and okay, done. And it'll actually open it up for you, so you don't even have to go and find it. And now this version you will be able to edit. So on the first sheet here, we've got a bunch of data that you need to input, and this will essentially be the data that we use, and that is formulated into the other sheets. So a lot of these other sheets use formulas, and they will be using some of the numbers that we've entered in here. So first you need to find the sales for the past 10 years. Now you can find this for American companies on quickfs.net. On Australian companies for 10 years, I generally just go on CommSec, which is my broker. They have financial data there. Or you can go into the individual annual reports, which you can find on the investor relations page of whichever company you're looking to invest in. So you can find the sales numbers or revenue, same thing, the earnings per share, equity, and then the last one is free cash flow. Now, free cash flow isn't on the annual reports. You'll find it on QuickFS and maybe some other websites. But essentially, if you need to calculate it manually, you need to take operating cash flow on the cash flow statement and subtract purchases of property, plant, and equipment, which is again on the cash flow statement. And the difference between those two is what we call free cash flow. Then we've got a couple others here, just 3 numbers of current assets, current liabilities, and total liabilities. The 5-year low PE ratio or 10-year low PE ratio, high and the average, and then the return on invested capital, which you can also find on some websites such as Macro Trends or MSN Money. Now, as you can see, most of it is grayed out. The gray areas are parts that you shouldn't touch. So you can only enter data, or you should only enter data into the white cells. And if you have all of the white cells filled out, then it should work. So I'll just go and copy these over just in the interest of time. So I'll copy those over. And I'll grab these three. And I haven't entered the return on invested capital. Let's just pretend it's 8 and 12. We'll go with that. And what you'll notice is once you've entered in these current assets, current liabilities, and total liabilities, these debt ratios will calculate for you. And essentially, we're looking to find a current ratio that's above 2 and a debt to equity ratio that's below 0.5. So if they don't meet those requirements, they're going to be yellow. But if they do meet those requirements, then it will color in the cell green. And with the return on invested capital, we're looking for both of these numbers to be above 10. So you can see that the 5-year meets it, so it's green, and the 1-year doesn't, so it's yellow. The next tab we have is the growth tab, and on this tab there is nothing that you need to edit. This is completely formulated for you, and it's essentially calculating the compounded annual growth rate over different periods. So this is the 1 year, so would be from 2017 to 2018. What's the growth rate there? And then we have, say, the 9 year, which is going to be calculating from 2009 up until 2018, and what is the compounded annual growth rate. And again, it's color coded because we're looking for these numbers to be above 10% consistently. We're looking for companies that consistently have 10% growth over the long term, but also in the short term. And there's also a graph here so you can see how the growth is trending. We're also looking for companies that have growth that is trending upward so that we can be confident in using these long-term numbers as predictors of future growth. The next tab we have here is the value matrix. Now this is where we're going to be able to estimate what the future stock price of a company is, and therefore how much we should be willing to pay for it today. So if we enter in the earnings per share, I think I have it on this other sheet. So we've got earnings per share of $2.14, and the current price is about $50 per share. I think that's still accurate, so we'll just go with that. And we're looking at 10 years. And you can see here on the bottom table here, we've got stock price in 10 years. If you change this to 5, it'll be stock price in 5 years. So you can put whatever you want there. And essentially, we've got a bunch of different growth rates for the next 10 years for their earnings growing into the future, and a bunch of different PE ratios that are based on whatever you've entered in here. They're high, they're low, and they're average. And this will give us a range at which their stock price will be at in 10 years' time. So based on these growth rates that have automatically been calculated from this table here, and using the PE ratios, we can see that the stock price for the Cheesecake Factory is going to be somewhere, or likely going to be somewhere, between $25 per share and $107 per share. Now, one thing I will make you aware of is that these growth rates over here can sometimes be very misleading. So I always manually enter these in. I always delete these, and you can see that it's white, so you can delete them. Don't delete the ones at the top, they're formulas. Just delete the white cells and edit these. So let's say we think they can go at 0, 2%, 4%, 6%, or 8%. And then in the top table, what that will estimate for us is what return we're going to get if we paid this price over here, this $50 per share. So you can see that if we bought it at 50 and then the stock price fell to $21 per share over the next 10 years, we would make a return of negative 8%. And then we can play around with this to work out what price we would be willing to pay based on what return we want to make. So if we want to make, say, a 10% return from the stock price going up, then maybe we would need to pay around $20 per share, because that would mean if it grew at 4% and they had a PE of 17, then we would earn a 10% return per year, because the stock price would be at about $54 per share in 10 years' time. So you can have a play around with that, but again, this is just it's really dependent on what growth rates you put in here and what PE ratios. So you can't just chuck in all the numbers and let it automatically calculate it and then assume that it's going to be accurate. You need to then go ahead and make sure that these growth rates are actually achievable for the company that you're looking at. The next tab we've got here is the buy zone calculator. So this is another place where we can estimate how much we should be willing to pay for a company. So again, I'll put in the earnings per share, the time frame, we're looking 10 years out, the current stock price, let's say about $50 per share. We've got a margin of safety that we're allowing for errors in our valuation. We can edit that, but I always leave it at 50. And then we have our required rate of return, what return we want to make. I always put that as 15. And then essentially we have an auto buy zone calculator, which automatically calculates a growth rate from our growth estimates in this other tab. But again, this can often be misleading. In the case of the Cheesecake Factory, it's honestly not too bad at 5%. That's very conservative. But in other companies, this number will be way too high and you'll want to manually enter in this number for yourself. So that's why we've got the manual buy zone calculator. Let's say instead we know that the Cheesecake Factory can grow at say 12%, then that would give us a fair value, the intrinsic value, the buy price, and the sell price. I usually don't sell my stocks. I'm usually a buy and hold, so I usually don't use this. But if you're someone who wants to buy in and out of stocks, then you would want to sell the stock when it exceeds its fair value, which is why that says that there. And then it's got the decision whether it's a buy or sell based on what the current stock price is. So this says it's a buy at under $14. So if the stock price was 12, it would be a buy. Now remember, all of these calculations are based on stock price growth and do not include dividends. So for example, the Cheesecake Factory pays a significant proportion, about a third of their earnings out as a dividend. So that's something you got to be aware of. Using these models here, which I don't use too often anymore, they don't allow for the fact that they could be paying a dividend. And then there's one final calculator over here, which is the payback time calculator that Phil Town uses. I have a video on that if you're interested in checking that out. And essentially you just enter in the market cap. So this one we're comparing the whole company instead of a per share basis. So we're looking at the free cash flow for the entire company and the market cap, which I believe was 2.2 billion. And the growth estimate, let's say 12%. And that will give us a payback time. So how many years it will take for us to get our initial investment back. And we're looking for a payback time of less than 8 years. So in this circumstance, it would be a buy. If this was 4%, I'm guessing it's not a buy. No, because the payback time would be 9.5 years. So that brings us to the new tab that I've just introduced, and that is the discounted cash flow. And this is what I use to value stocks on a daily basis. So what we do is we enter in the cash flow for the company. I'll just do one example, but I use 5 different models because I like to see a range in the same way that we use the value matrix. I like to see a range at which their intrinsic value is likely to fall. So let's estimate that they can grow at 4%. Actually, we'll do 5 models. Let's do it. We'll go 0%, 2%, 4%, 6%, and 8% growth, and we'll use that 155 million of free cash flow that they produced in their last year. It was 188 million actually. Let's change that. And then essentially you want to enter in the latest 10-year treasury yield in here, which is, I think it's at about 2.5% at the moment, but I always use 3%. I never go below 3%. And then our required rate of return. So here I've got 22%, which is what I target, which is essentially a 15% return with a 50% margin of safety included in that. And then from that, we get this table that calculates the intrinsic value based on the current 10-year treasury yield, which is what we could get by taking no risk. And then the buy price based on what return we want to achieve. And this is a whole company buy price. So that's 2.9 billion. That's 3.4 billion, that's 4 billion, and over here that's just under 1 billion that you would buy the whole company for if you thought they couldn't grow their cash flows and they were going to produce about 190 million in cash every year for the next 10 years. Now, the reason I like to use discounted cash flow is because I can enter this cash flow in here to include stock price appreciation and also dividends. So this is a number that is essentially the free cash, but I also manipulate this number a little bit, and I'll make a video talking about that in the future. But this number, essentially, what I enter in here represents how much is going to be reinvested in the business, how much is going to be paid out as dividends, how much is going to be used to buy back stock, and how much is just kept as cash on the balance sheet. And this is an accurate figure of how much cash is returned to shareholders in a particular year. And of course, also you can do this on a per share basis. So if we wanted to enter in the current earnings per share, we could just do it like that. And then we would get our buy price and our intrinsic value based on the earnings per share. So this would be a $10 per share buy price, $10 to $16, which is pretty similar to what we got on these calculators. And it's pretty similar to what we got in the value matrix as well. So we're getting very similar results, and I'll usually compare between the three, but discounted cash flow is the main one that I like to use. And then the last tab here is just a simple way that you can enter in all of your holdings if you want to see the breakdown of the percentages. I don't use this, I use a different website, but I thought I would chuck that in just in case some of you wanted something simple like that, just to keep track of what percentages you have in cash, in stocks, and in other assets. So I hope you guys enjoyed watching this video, and of course, as a reminder, if you want access to this spreadsheet for free, then click the first link in the description below and you can get access to it straight away, and you can come back to this video as a reference just so you know exactly how to enter in each of the data points and what each of the slides mean, because sometimes it's not as easy just to do it by yourself. But I hope you guys enjoyed this one, and if you did, make sure you leave a like and let me know down in the comment section below what you want to see me add to this spreadsheet in the future as I continue to make iterations and continue to develop this spreadsheet. But for now, guys, I will see you in the next video.